very much, and thank you to Joe as well. That's going to be a tough one to follow up with the subject matter that I'm delivering, but I really sort of like that slide and that message about VUCA, because that's definitely the current state of the UK corporate reporting environment. And there are so many themes in that presentation which are sort of subtly relevant to the future direction of corporate reporting in the UK, and to where, in fact, the government are in leading corporate reporting, as well as the position of the Financial Reporting Council. And one of the things as well, just to keep the theme of theoretical physics live, is that corporate reporting is either at a crossroads at the moment, or is it a turning point? Now, it could be at both of them at the same time, and that's where people like Heisenberg comes in with his uncertainty principle, that you can't be in two positions at the same time, but you can in the world of quantum mechanics. But in this country, as in other countries, clearly, the direction of travel of corporate reporting is driven by the government, and our government obviously controls the legislation, which ends up shaping the legal requirements and then the form of what is out there, what we're required to do, how that is regulated, and as a consequence, with the regulator, how our accounting standards and rules and audit rules are developed, and then ultimately how that is all monitored. I was sort of thinking, going back about 2 to 3 years ago, that I think, obviously, for many reasons, the world was quite different to what it is now. But the world of corporate reporting and the future direction of corporate reporting was certainly different, because it seemed as though 2 to 3 years ago, 3 years ago in particular, we were moving towards a much more highly regulated accounting and auditing requirement. It was clear that narrative reporting disclosures were going to get far more transparent and complex. We had the various things with changing Companies House, making things a hell of a lot more transparent, requiring identification of the directors, requiring more things to be filed at Companies House in electronics form. But I think now, at this current position, with the exception of the changes to UK GAAP, and also in respect of sustainability reporting, both of those areas are seeing increases in complexity. The question is, as the other aspects of corporate reporting, has there been a peak in that complexity, and will we be going backwards in a sense of trying to make things more simple, down to earth? So this morning I hope to capture what might be the future direction and the prospects for corporate reporting in the United Kingdom. So what shall I be talking about? Look at the expected future direction of corporate reporting through various lenses. An IFRS update, and that will be relatively brief. A UK GAAP update, recapping some of the biggest changes that we've seen for quite some time in the world of UK GAAP reporting. Changes to the Companies Act 2006, and this is where we might see indications of a turnaround and how the government is possibly simplifying things. As Joe pointed out, and as we saw in our survey, there is a need for profitability and efficiency, because they're key drivers of growth, and I think the government and the regulator have got that message. And some corporate reporting tips for the next financial reporting season, or the current one, or if the directors out there and the financial controllers and other preparers of financial statements, if they're dealing with draft financial statements at the moment, hopefully some of the tips will be helpful to you in drafting the next set of financial statements. So the expected direction of corporate reporting. And this is from this year that the Department of Business and Trade, and that is the government department that sort of obviously is in charge of the overall business environment in the United Kingdom, but it's in charge of most of the aspects of corporate reporting and for developing company law, for example, the Companies Act 2006. And they made a particular announcement where they actually stated, right, we need to promote growth in the UK. And the key to that is removing red tape for business. So what they had billed as their wider package of audit and corporate governance reforms that were going to extensively sort of change and increase regulation for directors, for companies and for auditors, everybody was going to be effective. That will be no longer taking place. So that also means that the definition of a public interest entity, i.e. those entities that would be under much more audit scrutiny and audit regulation, they're not extending the definition of a public interest entity to any further entities. So in simple terms at the moment, banks, insurers, credit institutions, entities that are listed on a UK regulated market, whether that is equity or debt, are the headline examples of public interest entities. There are going to be some more added to that population, but that is not going to be made. And many directors will be pleased that the government is not proceeding with a new enforcement regime that could, in a sense, sort of, and I'll say the word, prosecute directors for any of their perceived wrongful actions in governing the company as a result of regulation enforcement. And that was met by a letter from the Department of Trade to the chair of the Business Select Committee in the House of Commons. And so they reiterated the point that there's no longer any consulting on major packages of audit and corporate governance measures. Deregulatory measures should be taking place. The focus now should be on the simplification and modernisation of corporate reporting. The world is changing. We're getting more technologically based. People are using digital formats a lot more. AI is over our shoulders. But they want the UK's reporting regime to become the most streamlined and proportionate in the world. And an ambitious consultation will be launched to co-design those changes with companies and investors. And that is, it's a wait and see to how big that is going to be, but that is a very, very big promise from the Department of Business and Trade. But the Department of Business and Trade did acknowledge that changes and improvements in audit regulation since the Carillion debacle in 2018 have been visible, and they're happy with improvements that have been made to date, putting things in the right direction. In terms of the Department of Business and Trade, they are the main body that sort of oversees the Financial Reporting Council. The Financial Reporting Council is its own body, but it is a spin out from the government as such, so it is effectively controlled by the government, Quango, for a better word. And the Department of Business and Trade have said that they work closely with the FRC to support some of the measures that they've already taken and to make the audit market work better. And with that, minimising burden for companies and directors, but also supporting overall growth in the economy. So the message is that the audit market is still very important, and also that the government will still look to put the Financial Reporting Council on a proper statutory footing, but with a proviso that as soon as parliamentary time allows, and one things that we've seen with the government and the nature of the government's agenda at the moment is that, you know, there is a hell of a lot of demand on parliamentary time. So there is no sort of set time limit for when that may happen. But it is something that they're looking to do. So the idea of replacing the Financial Reporting Council with ARGA doesn't seem as big anymore. And if they're still talking about putting the Financial Reporting Council on a proper statutory footing, maybe they're talking about actually leaving the Financial Reporting Council as it currently is. But in terms of some of these changes, I will reflect a quote from Andrew Moyser, who is an audit partner in the firm, and he is our head of audit, and I work very closely with him on a number of things in relation to corporate reporting. And it's very important to note from Andrew's perspective that, you know, while the UK Audit Reform Bill has been scrapped, you know, the regulatory scrutiny hasn't eased, and the audit expectations, inspection intensity and enforcement activity remains high. And that is sort of reflected from the fact that over the last couple of years that the Financial Reporting Council has got bigger, it has recruited more people, it's recruited more specialists, so they can do more work and get more actively involved. But particularly for that, it's focusing on larger and higher risk businesses. So the theme may be to let the engine of growth of the UK sort of operate a little more freely with a little less scrutiny. But importantly, Andrew notes that directors and finance teams should not expect audits to become less challenging or less costly as a result of the decision. You know, finance directors should really focus on deriving genuine value from a well-managed audit rather than viewing the audit itself as a compliance exercise to be endured. And I think that latter message is something that has sort of echoed through the market and with some people. I was an auditor once, but I remember years ago being able to go out to audit clients and not breach any independence rules or anything like that, but I actually felt as though I was actively supporting them and actively you know, supporting their teams, helping everybody learn, understand and find improvements in their business. And I always felt that I was doing that without actually breaching any independence rules. And as we know at the moment in the audit market, it's a lot more difficult to actually operate as an auditor, particularly for public interest entities. There are so many rules, regulations and ethical considerations as a result of many failures out there, including things like Enron. So it is an important thing to see. I'd love to know in 10 years' time what the actual audit landscape will truly look like. I personally have no real idea at the moment. So what are the Department of Business and Trade currently driving? Well, the key anticipated developments are the removal of the requirement for all companies to prepare a director's report. That is expected to be formally announced properly in the consultation that they are expecting to issue in 2026. The idea also is to exempt most medium-sized businesses from the need to produce a strategic report. Currently, medium and large companies are required to produce a strategic report in their annual report. Small and medium-sized entities won't be required to do so in the future. And also, in addition, to reduce the scope of narrative reporting, there is an aim to actually exempt wholly owned subsidiaries from the need to produce a strategic report if that wholly owned subsidiary is included in a group set of financial statements where a group strategic report is produced. The government believe that energy and gas emissions should be retained because it's a useful standard. I spoke to somebody within the Department of Business and Trade, and they actually said that nobody really looked at this. So I'm surprised that they actually believe that that is useful, but I hope that comes from the investors, really. And large companies, instead of a strategic report, there will be a form of strategic and sustainability report covering those types of matters. So as the Department of Business and Trade says, the government has listened and has expanded the scope of its reform, and there is a modernisation of corporate reporting programme, and that broader consultation will be delivered in 2026. And they hope that that will meet what industry has been asking for. And a lot of the issues are about co-designing reforms and working with investors, working with companies, working with the markets to improve things, and all of that in particular in the light of corporate reporting functioning in the digital age. So on to the Financial Reporting Council. So the Financial Reporting Council is the entity which governs our accounting standards, auditing standards, corporate governance, oversees actuaries, oversees a number of matters, but their priorities that they issued during January 2026 were really to ensure that they're underpinning investor and overall broader confidence in UK PLC, and that's where there is this perceived need to grow. So instead of facing regulation and creating regulation to make a much more perceived secure framework, the FRC is turning around and looking at underpinning that broader confidence and making the UK a great place to do business. And that includes reducing unnecessary burdens, but also ensuring that high standards are maintained. And they say that they will develop deep insights of the markets that the Financial Reporting Council oversees, identify future trends and innovate to support the health of those markets, and also to support the skills and resilience of the profession that we regulate. And that is quite a different message to when ARGA was first muted. So some of the victories that the Financial Reporting Council state that they've done so far is reducing the corporate governance code by 20%. And they promise to work with anyone who has an interest in the ambition to look out for opportunities to ensure that work is proportionate and effective. They will make progress on the future of their audit supervision strategy and look at an end-to-end enforcement review, but making it more proportionate, system focused as they modernise audit regulation. And the key thing as well is supporting the SMEs and publishing guidance that help auditors deliver appropriately scaled work to their clients. And some of those improvements and innovation initiatives are seen on the Financial Reporting Council website. There's an innovation and improvement hub. For entities, the sandbox of simplifying annual reporting was actually sort of more focused on inviting smaller quoted companies and AIM companies to sort of offer their annual reports and offer ways which things can remain compliant with regulatory requirements, as well as being user friendly and concise, i.e. making the annual report much more accessible to a variety of users. And other areas are around like innovating around the auditors, the smaller auditors, and the auditors that are involved in PI audits as well. So, the Financial Reporting Council has put a lot of feelers out there to look for ideas. and look for those initiatives and those innovations that are out there somewhere.
Apologies for interrupting, Neil. Would you mind taking control of the slide so that you can navigate through the rest of them? You've lost control of them at the moment.
Oh, okay.
Thank you.
Okay, so that's come back. So I'm back at the IFRS update. And in terms of the International Accounting Standards Board, the International Accounting Standards Board Foundation, which controls the International Accounting Standards Board, also controls sustainability and the International Sustainability Standards Board as well. And since that's happened, there's actually been like a reduction in the number of active projects. But some of the big ticket projects that we're looking at in the future are around the disclosures in respect of business combinations and goodwill, the accounting for intangible assets, the accounting for equity accounted investments, for example, associates in joint ventures, and also looking at exposure drafts of amendments to the standard which governs the statement of cash flows. Now, in the current remit of the International Accounting Standards Board, various amendments are actually in place during the period, and we're at a point really that during 2025 and 2026, the amendments to IFRS effective for periods on or after the 1st of January 2026 are largely improvements and innovations that are sort of reflective of the changes in the economy. For example, electricity contracts for producers of electricity, matters relating to when electronic payments should be recognised in financial statements, and then also when related financial instruments that depend on electronic payments should be de-recognised. The big changes in the future for published standards really do lie around the presentation of financial statements, and in particular IFRS 18 is the big change. There is another standard for reduced disclosures, also for subsidiaries without public accountability. That isn't yet endorsed for use in the United Kingdom, but it's a wait and see whether the UK gets two particular reduced disclosure frameworks for subsidiaries, one under IFRS 19 and one under FRS 101. In terms of UK GAAP, the known changes are effectively what we actually covered in our webinar in November 2025, and the slide here does show links to those particular slides. Now, obviously, the key changes there are in respect of revenue recognition and for lease accounting. There are other changes, but I do plan to do more external webinars on this. I plan to do a webinar that focuses on leases, a webinar that focuses particularly on revenue, and a webinar that focuses on other changes as well as guidance to the strategic report, which was actually issued very recently as well, some new guidance out there. So please look out for those. The Companies Act 2006. What we know so far is that we know that for periods on or after the 6th of April 2025, there are going to be increases in the size limits for companies and LLPs, and that will make a lot more companies exempt from an audit, make a lot more companies available to take advantages of not preparing a strategic report because they qualify as small, and therefore many companies also qualify for simpler financial reporting requirements under the small companies regime. Aside from that, there have been changes to the directors' remuneration report requirements for quoted companies. and those simplifications might be welcome because those regulations are quite difficult. From the 1st of April 2027, the government have announced that accounts must be filed using commercial software. From that date, the government had announced that micro entities and small entities would be required to file a profit and loss account at Companies House as well as their balance sheet, and also the small companies would be required to file a director's report at Companies House as well. For all of that from the 1st of April 2027, but that is clearly expected to be shelved. That is the message on the street. Sometimes when you go into Companies House and you click on the icon where it says company law is changing, it still refers to that, but there is an understanding that there is going to be something peeled back. Whilst the accounts will need to be filed using commercial software, there has been a lot of background debate and pushback regarding what small companies and micro entities are required to file at Companies House. So hopefully we'll see some clear clarity on that in the very near future. And here is the roadmap for those changes in company sizes that include companies and parent companies, and those changes are for accounting periods commencing on or after the 6th of April 2025, and we cannot adopt those changes early. Once we're dealing with accounting periods commencing on or after the 6th of April 2025, what we're allowed to do is measure the comparative financial period under the new rules, so that will allow more companies to qualify as small. And for completeness, I've included some slides in regard to those changes in company sizes. So finally, some corporate reporting tips for the end of the season. The Financial Reporting Council every year issue their annual review of corporate reporting. I think it was released in October 2025, clearly after the last FD seminar. But their key messages are relatively consistent with prior years, that the FTSE 350 companies they review show consistently high standards compared to others. Smaller listed companies show lower reporting quality. The key areas for improvements are in relation to impairments, cash flow statement reporting, and explanations of key assumptions. But one good thing to note is that the Financial Reporting Council did see fewer restatements of financial statements as a result of their reviews of financial statements of larger and listed companies. But their key expectations are to ensure that those pre-issuance checks are performed to ensure that the financial statements, the annual report, does comply with the technical requirements, and that those technical compliance issues are sort of addressed at the time that financial statements are approved. In terms of the top 10 issues, impairment of assets, cash flow statements, financial instruments, they're the top 3. Presentation of financial statements moved up to number 4. Revenue has dipped slightly, but it's still in the top 10. Issues regarding strategic report and compliance with the Companies Act 2006 are still high. Judgments and estimates are still there as an issue. Chris, you will be pleased to know that income taxes does remain in the top 10 reporting issues, but it is falling down the charts. A new entry being consolidated financial statements and issues around consolidation. Also getting lower is climate reporting and climate related narrative reporting. So that is falling down the charts as well. And where I put an exclamation mark, that denotes that those are the areas of reporting that did require a restatement. So finally, in the annual review of corporate reporting, the FRC included this specific thing, which I think is really useful to most entities that are preparing their annual reports at the moment. So the issues being those pre-issuance checks, making sure that there is a sufficiently robust process to review the financial statements. Not only is that for the auditors, it's for the directors and those preparers within the company as well. And looking at those top 10 issues helpfully will look at those issues where the common problems may arise. And the FRC always say this, but it is ensuring clear, consistent disclosures about judgment, uncertainty and risk, because they believe those disclosures are so important to investors. Strategic reporting, directors' reports, i.e. narrative reporting, ensure that those reports are fair, balanced and comprehensive. They mix the good and the bad. Ensure, don't do boilerplate disclosures. Make these things sort of personal. So finally, my comments are, when you're looking at your annual report, make sure it tells a clear, consistent and coherent story. That it's clear, concise and understandable, and includes all of the necessary material and relevant information to the users of those financial statements, and to a degree only includes material and relevant information, because where financial statements are full of immaterial items and irrelevant stuff, it really does detract from a good set of financial statements. So that is that from me, and I think now we head to a break. So thank you very much.
Brilliant. Thanks, Neil. Lots covered in just half an hour there. Really appreciate it. Interesting to see the kind of audit reform taking a back step, and obviously tax advisor registration coming in later this year as well. So definitely a pivot on approach there. Really appreciate that insight.